Gold is an asset that has always played a very important role in the Indian scenario. Before we delve into the situation in 2020, let us look at the various types of investments in gold that are possible, the difference between the spot rate and the future rate in gold, and also why gold is regarded as the safe haven assets and what determines the price of gold. What are the types of investment in gold? Number one is the bullion. The best known form of direct gold ownership is the bullion, which is nothing but gold held in the form of bars as well as coins. Gold bullion is any form of pure or nearly pure gold certified for weight and purity. As we can see from the description, it is illiquid in nature when held in the form of huge bars, but it is a little more liquid when held in the form of coins. The heavy gold bars weigh up to 400 troy ounces, while an ounce is equal to 28.35 grams. A troy ounce is equal to 31.1 grams. So when we say an ounce with respect to gold, we mean a troy ounce. Number two, gold exchange funds. So, one way to invest in gold indirectly is without purchasing the actual metal itself. And this can be done through ETFs. Each share of these ETFs represents a fixed amount of gold, for example, 1/10 of an ounce, and these funds can be purchased as well as sold just like stocks. This method is more cost effective than owning gold directly, and we can also make a very minimum investment as what we have to pay is only the price of a single share of the ETF for the minimum, unlike the bullion. One needs a demat account in order to invest, but for the bullion, the paperwork is lesser than the ETF. This type of investment also includes the brokerage charges, so the returns might be lesser than the actual increase in value. We also have gold futures. Futures are nothing but contracts to buy or sell a given amount of an item in a predetermined price in a particular agreed upon date in the future. In this case, that item is gold. The prices of gold future are a little more volatile in nature when compared to the bullion or even the ETFs. Now, let us look at, and also investment in gold can be done through sovereign gold bonds sold by the RBI. And also, we can invest in mutual funds that invest in gold mining companies. And that is different from investing in gold itself. Difference between the spot rates and the future rates are what we're going to see next. Now, spot gold, as the term implies, refers to the trade in which gold is purchased immediately and the price is also determined instantly and the cash is almost interchanged instantly. Now, when it comes to the futures gold, as we saw before, futures gold refers to a trade in which a transaction is executed on a particular date, but the product delivery will take place only in the future at an agreed upon date. Typically, it means that you will pay for the gold now, but we will be able to take the delivery of the gold only in the future. So now let us take a person called Mr. Ram. He has a keen interest in gold and he decides to purchase 10 grams each from the stock market as well as the spot market as well as the futures market. So the price for 1 gram gold in the present is 5,500 in the spot market, and he pays 55,000 for 10 grams in the spot rate and takes delivery for it. He also agrees to pay rupees 5,700 per gram for gold futures. So when it comes to the futures, there is a little bit of a price increase because it also includes the carrying cost of gold. So future prices are a little bit higher than the spot prices in order to account for the storage as well as the delivery. So he also agrees to pay rupees 5,700 per gram for the gold futures, the delivery for which he will take after 4 months. He signs a contract a week later, paying rupees 57,000 for these 10 grams. After 4 months, the cost of gold is now 6,000 per gram, thereby providing him a profit of rupees 3,000 on his futures purchase. So he bought it for only 57,000, but when he's taking the delivery, the price has gone up to 6,000. So he's making a 3,000 profit on his 10 grams purchased of gold. So this is the difference between the spot rate as well as the future rates. So a lot of speculators invest in the futures market, and a lot of people who want to hedge against risk also use the futures market. Now, let us look a little bit into the multi-commodity exchange. Just like we have the NSE and the BSE, which is the National Stock Exchange and the Bombay Stock Exchange for trading in stocks, the MCX or the multi-commodity exchange helps us trade in commodity futures that include gold and silver, but it is not limited to that. The futures price of gold in India is usually known as per that of the MCX. But the MCX does not determine these prices, and it is in turn dependent on the international price, the US to INR conversion rate, the quoted unit of gold or silver, troy ounce to grams conversion, and the supply and demand of gold and silver in MCX trading. So we can give a simple formula, which is the gold price calculation formula for 10 grams is equal to the international gold price into the USD to INR conversion into 10 into troy ounces to grams conversion. Now, let us move on to why gold is seen as a safe haven asset. So first, what is a safe haven asset? A safe haven asset offers diversification to an investor's portfolio, helping it withstand volatility or short-term swings in the prices of assets that are more vulnerable to market whims. So if there is any sort of uncertainty which is going to affect the broader markets, then it will tend not to affect the safe haven asset. And that is why investors flock to it in times of uncertainty. So these safe haven assets, they typically perform well during the downturns in the economy and the financial crisis when the riskier assets tend to underperform. So the riskier assets can include stocks. Now, Warren Buffett in 1998 said gold get dug out of the ground in Africa or someplace, and then we melt it down, we dig another hole, we bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their head. But why do we trust in gold? The simple reason is because it has worked in the past. Gold has always been looked at as a store of value and has played a very important role in the monetary system of the world. Further, gold is virtually indestructible, meaning all the gold that has ever been mined is around in circulation. Gold is also seen as a hedge against an inflationary situation. So while gold, silver, palladium, and platinum are all precious metals, the latter three are not commonly accepted safe havens because they play very different roles in the monetary and investment. They have played very different roles in monetary and investment in the past. Now, if we look at this chart, we can see that in 2000, 2001, 2002, the gold prices are pretty much stable. But in 2007-8, we can see a sharp increase in the gold prices. And that is because of the 2008 financial crisis. And during that time, everyone was flocking to gold. And also after that, we can see that in 2011, there is a sharp increase in gold, and this was because of the uh, attack on the twin towers in USA in September. So after that, gold has remained steady, but again we can see that in 2020 there has been a sharp increase. So when there is overall economic uncertainty like that of the financial crisis in 2008, or when it came to the twin towers blast, which had a lot of political uncertainty, gold still manages to hold its value, and that is why it makes it a safe haven asset, and therefore resulting in an increase in the price. Now, let us look at the relationship between gold, dollar, as well as the interest rate. For this, we have to first take three things into consideration. Number one is that gold is inversely related to the dollar. Now, let us explain this. As a rule, when the value of the dollar increases relative to other currencies around the world, the price of the gold tends to fall in US dollar terms. It is because gold becomes more expensive in other currencies. As the price of any commodity moves higher, they tend to be fewer buyers. In other words, the demand recedes. Conversely, as the value of the US dollar moves lower, gold tends to appreciate as it becomes more cheaper in other currencies. So demand tends to increase at lower prices. It is important to note that both USD and gold are seen as safe haven assets. Now let us look at an example. 1 ounce of gold is equal to $1,940, and 1 unit of dollar index is equal to 90. If $1 becomes 85, then 1 ounce of gold will demand more dollars. So therefore, gold is inversely related to the dollar. Dollar is directly related to the interest rate. So this is because when the Federal Reserve increases the interest rate, more investors will start investing in the US, and therefore it will lead to an appreciation of the US dollar. And gold is inversely related to the interest rate. And this is because gold does not yield any interest on itself. So therefore, if the interest on other assets are higher or they increase, then the demand will for gold will be less and vice versa. In 2020, there were a lot of things that were very conducive when it came to gold. So number one was the accommodative monetary policy or low interest rates. Since gold is inversely related to the interest rates, it was a positive for gold. And also there was uncertain or weak economic outlook and a lot of political turmoil and uncertainty, and therefore that was also a positive for gold. And also, since the gold and the dollar is also inversely related, a weak dollar in 2020 also greatly helped gold. Now, if we look at the picture, if we look at this graph, we can see that in 2017, the blue line indicates the dollar index and the orange indicates the gold. We can see that in 2017 the dollar index is higher and therefore the gold is lower. So throughout this graph we can see that when the dollar index is higher, gold is lower. When it comes to 2020, in the beginning dollar index is higher and gold is lower, but after the onset of the pandemic, especially in the highlighted part, we can see that as the dollar index falls, the gold prices increase, and in August it reached almost $2,000 per ounce. And we can see that through this graph we can see that there is an inverse relationship between the gold prices as well as the dollar index. Now let us look at specifically to 2020. In 2020 specifically, in the beginning we can see that both gold and dollars aren't very high, but in March we can see a very steep fall in gold. This is because of the lockdown, which had greatly affected many asset classes, and there was a massive sell-off in gold in order to cover losses in other areas. After that, we can see a steady increase in gold with the fall of the US dollar. The mounting uncertainties, lower interest rates, and pessimistic sentiments greatly helped gold in 2020. After the news about the vaccine, the gold started falling as investors gained more confidence to invest in other interest-bearing securities, as we can see from the graph. But the fall in gold hasn't been that much. Now let us look at India. In India also we can see the same trend. In the beginning, gold is pretty stable, and in March there is a massive sell-off, so there is a plunge. And after that, gold is steadily increased, reaching almost 50,000 in August. When we look at the annual increase in gold, has been about 38% during this crisis. During the Lehman bankruptcy, it was around 36%, and during the World Trade Center attack, it was around 13%. So the annual increase during any crisis has been the highest during this pandemic. We can also see that from this table, in the beginning of January 2020, the gold price was around 41,150. But in August, the gold price was around reached almost 56,000 rupees. Gold reached almost 56,000 rupees per 10 grams in August when the COVID cases were surging and there was high amount of uncertainty. We can see that it has declined a bit in the later months due to some positive sentiment related to vaccines and recovery, but the decline has not been much. And now with the second wave of the coronavirus starting, gold has again gained a stronghold. Gold may also be seen as a safe haven asset just because it is very simple and well known. Throughout history, we have always trusted in gold. Some factors influencing its price are very tangible in nature, like the physical supply and the demand of gold, interest rates, as well as the dollar index. But many factors influencing the gold's price are not tangible in nature, and they may be very psychological in nature. They may include the perceptions and the preferences and the market sentiment, and a lot of psychological factors also play a very important role in why the gold price is determined. I will end with the words of the US Federal Reserve Chairman Ben Bernanke in 2013. Nobody understands gold prices, and I do not pretend to understand it either. But even though the gold prices are not very easily explainable in some cases, we need to its importance, especially during times of recessions and depressions, cannot be understated. Like we've seen in the past year and also in previous instances in history. Thank you.